Hey everybody, Jake and Gino here. And it's a hot market out there, Gino. A lot of people are doing some aggressive things when it comes to financing their multifamily deals. And specifically, a lot of folks are going to bridge debt because they're simply not qualifying for traditional financing. Many times, this can be a great option. We use community banks, for example, as a bridge option. But traditional bridge debt does have its risks. So G Papa Funk, master wizard of all things multifamily, Mr. I got a flannel on today and I'm ready to bring the panya. Please explain to the folks how multifamily investors are using debt right now and your personal opinion of it.
First of all, I am the master of disaster. That's the only master that I am, Stenzi. Not the master of anything other than that of disaster. And I think right now it is the early 2022. Bridge debt years ago was used for a single purpose. If a property wasn't stable for 90 days at 90% occupancy, you needed to go in there and use bridge debt to stabilize.
The heavy lifts, the big rehabs.
Exactly.
The shit kickers.
Now, when you're looking at a deal that's stabilized, but rents are at 900 and they have to go to 1500, and you're buying a deal that's stabilized on bridge debt, you've got to say to yourself, is there a risk in that? Well, number one, you better hope you can do it in a certain amount of time, because I think we can all agree interest rates have to go up sooner or later. I've been beating that drum. That's why I'm not the master of anything.
Dude, 10 years up 35 bips over the last week.
So when rates do go up and you're underwriting at a 3.5% exit 24 months from now, and that rate is 5 or 4.5, all of a sudden,
even 4,
you're in trouble. Exactly. So when you're looking at bridge debt, there is a place to it. We use a lot of community banks, what we call loan to cost. We'll use a loan to cost on these deals where we get 80% or 90% or 70% of the rehab budget built into the loan itself. And then we will work on that deal. We work really quick. We turn these units and then we go back to the community bank and we'll refi it to the community bank. And then from there, using the community bank as our quote unquote bridge for another year where we get the rents up even higher, have that management in place. And then we ultimately go to agency from there. It's a nice little process. Loan to cost from a community to the community again within the next year. And then from the community to agency within the next year. So it's a 2.5 year window for you going from unstabilized asset to beautifully stabilized long-term debt. I would caution everybody out there. How is your business plan? Is it strong enough? If you're buying a 194 unit property like Jake and I were looking at, can you get all those rents up from 950 to 1600 in a market right now?
In 2 to 3 years. Because here's the key that, Gino, you missed. The reason we use community banks is we're getting a 5-year term with a 2-year prepayment penalty. Mm-hmm. So we can get out, in 2 years and waive the prepayment. The key is with the community bank, they're easy to deal with. Mm-hmm. We're getting a 5-year term, if not more. And we know because of the relationship that we have, if we need to renew it, say it goes out to 5 years because we didn't get our rents up to where we wanted to, we're going to be able to refinance with that community bank. That's the kicker. That's where you can get stuck holding the hot potato with the bridge debt if you are not able to execute your business plan or there's a sudden change in the economy during the time that you're holding it. That's the key here.
And Jake, there's pros and cons. The pros of bridge debt, hey, you're getting non-recourse debt. You're getting interest only for 24 months. And
with the carve-outs. There's going to be carve-outs there.
Yeah, so let's just be clear. Exactly. But it's still there.
Fair enough.
Right? I think the other thing, bridge debt, it's a con, in my estimation, is the cost. I mean, when you're doing bridge debt, make sure you read the fine line and then the fine line.
How many points you paying?
I mean, you're paying a point up front of origination fee,
it.
plus other stuff. And then obviously this is a really, I don't want to call it a golden nugget, but an aha moment for us. When you're refining out of that bridge debt, do you have to use the same lender to go to stabilized? Make sure you understand that, because if you have to do that, then guess what?
Is there a refi fee?
That same fee going on to the next refi is going to cost you more money because there's no competition. So just make sure you go out there and that you find the person you want to deal with. We have a couple of bridge lenders that we use. If you want to reach out to me, Gino@jakeandgino.com, I can put you in touch with the bridge lenders that we use for our deals. We use a community bank for other parts, but we're trying to really build out our team here. So you want to have as many options as possible. Go to a couple of different bridge lenders and see what their terms are.
Yeah. And if it's probably, look, if you're doing a syndication, traditional bridge debt probably makes more sense. We just want everyone going into this eyes wide open, not hating on bridge debt. Just want to make sure that everyone's clear on what you're getting into. Look, there's, the old saying, fortune favors the bold. Sometimes a traditional bridge debt, package on a deal that's just super under market makes sense it's just not without risk. So a quick, recap on what we traditionally like on a stabilized deal is, look, we like non-recourse, low interest rate, long-term and long amortization. So 10 to 15-year term, 30-year amortization. And the reason we like this, and again, keep in mind, this all has to do with what your goals are. We're buy and hold long-term investors, okay? So we want to take interest rate risk off the table. Buy right, manage right, finance right. We buy it. That part of the framework is done. Now we got to focus on managing and financing. During the finance component, we want long-term fixed rate debt with that interest rate risk off the table. Push buy right out, push finance right out. You hone in on the manage right component, and you can work towards great customer service and a high profit per unit. That's our strategy. Doesn't need to be yours. I'm just explaining to you what we do. And it's worked great for us because the longer you hold these assets, you can count on the federal government to print more money. Rents will go up if you're in a growth market. And simply by holding on, buying right, and sitting tight, you can get rich in multifamily investing if you're doing the management, if you're doing manage right correctly, and making sure that you didn't overpay and getting the correct financing in place. It works very well for us. And I just want folks to be very clear on that, because our second deal that we bought, it was 2014. It was a 36 unit property. Rents were $350 a month.
For one bedrooms.
Okay. Let that sink in for a second. Fast forward to 2022, rents are $1,000 a month plus rubs. We have 10-year debt on it. We're probably 3 years into it at this point. Amortization is paying down. Okay. We got less than $1 million of debt on this property. Okay. Mm-hmm. So then when we go to refi it again, we're not going to add more debt to it. We're going to keep the level it is, continue paying it down. And then we're going to get very, very good financing because we're going to have such a great leverage position, loan to value with the bank. Mm-hmm. So what is it going to be? 50% LTV? You don't think they're going to give us a phenomenal rate on that next time we go back? So these are the things that we look at. If you're into it though, and you're going to hold it for 3 to 5 years and flip it out, that's a different strategy. So just to be clear, it doesn't make it, good or bad. I just wanted to open folks' eyes up to maybe what's on the other side of the coin in some instances.
Jake, let me recap a couple of things also that's really important. Number one, bridge debt is what we call a tool in the toolbox. The more tools in the toolbox you can have, whether it's creative financing, seller financing is a tool for strategy and finance, right? Whether it is traditional bank financing, whether you're going to an agency lender, whether you're using bridge debt, whether you're using loan to cost. These are all different tools in the toolbox. And the more tools you can have, the more deals you're going to be able to close. And I think the second thing that I've said a lot of times, and I think we all have to do this, and Jake and I were guilty of this, when you're underwriting a deal, especially when you're beginning, you need to think of what your exit strategy is. Is the exit strategy in alignment with the debt that you're trying to get? Like Jake said, if you're trying to exit this in 2 years, bridge debt probably works for you because you're going to refinance it. But if this is a long-term hold and you're not, you have to figure out what your exit strategy is and align that with your buy right criteria. Make sure you have your buy right criteria all up and ready to go. The deal looks good. Then align it with the tool that you're going to be using. Bridge debt does make sense in a couple of instances, and several instances that we've discussed. Community bank financing makes a lot of sense in several instances. Seller financing makes a lot of sense in certain instances. Just pick that tool up, make sure you understand what your exit strategy is, and then align the tool with your exit strategy.
You got Wheelbarrow Profits there on the desk?
I do. It's always on my desk. I'm always looking at it. I'm always looking at the Threelegged Framework. Gino at jakeandgino.com. I'll send you a PDF copy of this. And this outlines the buy right, the manage right, and the finance right. Things have changed. Things have evolved in multifamily, but it really comes back down to buying that asset properly. You need to know what your criteria is. It's all about what you need and what your strategy is. Then we teach that USP that Jake and Gino has with the students of over 35,000 units right now to date that they've closed. The manage right portion is so important because you're going to become a multifamily entrepreneur. We're going to teach you how to build those systems to build the business and ultimately finance right. Financing these deals, taking that risk off the table. And the buy right is done and the finance right is done. All you're doing is that wheel of the wheelbarrow, managing that property.
Well said, Gino. Gang, we'll see you next time. Thanks so much. Take care.
Thanks, Jake.